Hey guys, welcome back to another episode of the series. Now, today what I want to discuss is something that is very important. Everything within the market, like the strategies, the setups, the indicators, all of them can change, but something that does not change in the market that is very consistent is what we call liquidity. The easiest way to understand it is think of it as a tug of war, right? You have buyers pulling the price in one direction, you have sellers pulling the price in another direction, and whoever is stronger wins, right? And when you have a balanced approach where buyers and sellers are equally in strength, then the market just ranges, it consolidates. So what liquidity actually shows us is where traps are, where people have their stop losses resting, where the orders are stacked, and when all of that is swept, then the real move kicks in. So to understand liquidity properly, right, you need to think of it as a fuel, right? Price cannot move without it. Take it this way, that let's say you want to buy something, a nice bag, right, from a specific brand. Now, someone has to be willing to, sell it to you, otherwise you won't be able to buy it, right? So in a similar way, when big institutions, they want to buy $1 billion worth of something, someone has to be, selling it to them. There should be a seller on the opposite side. So what happens when there aren't enough sellers? They go find them. They literally, push the price into zones where stop losses are sitting, where orders are stacked, where a ton of people are going to react, just to create liquidity that they need to fill the positions, right? And if that's not enough, they'll manufacture it. What I mean by that is that they will engineer moves that look like breakouts, right? They will make patterns appear, like head and shoulder or trendline, things that get people to pile in on the wrong direction, right? False breakouts, fake structure breaks, all of it, right? It is designed to trigger behavior and create orders that they need. Now, before I jump into talking about the types of liquidity that you can find within the market, I want you to understand the sequence of events when it comes to liquidity and inducement of it, so we know, that we're trading in the right direction. Now, within the 4 phases of liquidity, the first phase is to actually identify the liquidity, right? Identify what type of liquidity is present within the market, and that should be the first step, right? Now, your second step is actually understanding where you are sitting within the cycle, okay? Because if you're too early, meaning that liquidity has not been yet induced fully, and you're trading thinking that it has, and you're trading opposite to it, then you can actually get stopped out before the price actually moves towards the initial direction, right? So you need to be able to understand whether you're in the manipulation phase or you're trading the after reaction, okay? Now, the third part of this phase is basically you need to look for inducement. You need to wait for whatever type of liquidity is present that you have identified for it to be induced, for it to be manipulated. Now, what I'll do is I'll quickly draw what these phases could look like. Let's say you have Asia range, right? So Asia is known for consolidating, ranging. It doesn't do much often. So you have some sort of liquidity resting above, right? Now, my first part of the phase is to identify liquidity. I've done that by noting that Asia high, we've got some sort of liquidity resting there. There's some sort of equal highs present there. Now, the second part is to understand whether that liquidity has been taken out yet or not. So clearly it's not. And let's say London opens somewhere around here. What does London do? Goes up, sweeps this liquidity. So your first part is done. Your second part has been finished. Your third part is done. So you look for inducement, which is done here. It's manipulated that liquidity. What you got to do at this point here is go down to your lower time frame, and you got to wait for a confirmation for an entry model to trade the opposite end. Now, for someone who is a bit more advanced, right, you can actually trade the manipulation leg as well, which basically means once I've identified the liquidity, I know my session's about to start, then I can actually trade that inducement, right? I don't just necessarily need to wait for the inducement to be done to trade the reaction. But that is a bit more advanced thing. Primarily, I would advise you to just trade once that manipulation part is done and a lower time frame confirmation is given. It just gives you more clarity, and you can actually trade the expansion part of the reaction. Now, we're going to start with something very simple. All right, how liquidity shows up around support and resistance, or supply and demand, and how it gets used against you, right? Now, this is in a form of equal lows. So first of all, right, we look at a flat consolidating range, which I can see, price is consolidating a bit here, right? And it keeps tapping the same low over and over again. So this low was formed, then price came down, tapped into it again, came down the third time, tapped into it again, right? All hitting roughly, you know, the same area, the same sort of demand zone. It looks like, you know, that price can't break through it. And naturally, people start thinking, well, if it's held it so many times, you know, price came down, it respected it, then we had a bullish breakout structure, maybe, you know, add a retracement into an imbalance or something, we should be longing that position. We should be looking for some sort of buys. And that there must be some sort of a demand here, right? There must be some sort of reliable support zone or a double bottom or triple bottom, right? Whatever you want to call it. There's a lot of terms that you can give this sort of price action. So what happens in this zone is that people start loading up on buy positions at this level, right? Where do their stop losses go? Right below it, right? So it could go here at random price points where they think their stop losses will be respected. Obviously, now, so we have this very predictable situations where a ton of entries are stacked at the support level, right? And a cluster of stop losses are sitting just below it. Now think about what that means from an institutional perspective. If they need orders filled, let's say they want to buy, right? And they want their orders filled. If they need liquidity, why wouldn't they just drive price below that level, below where their stop losses are resting, right? And collect all of it before sending the price up. And that's exactly what happens. This support zone, this demand zone, you know, 1 tap, 2 tap, 3 tap demand zone with a bullish breakout structure given here as well, right? This demand zone ends up being a trap. Retail traders, you know, they're sitting there expecting the price to bounce off again, you know, tap into the third time and just shoot up. But the problem is too obvious, right? It's too clean, it's too easy to target. So what does the price do, right? Price breaks below it. And when it does, two things happen at once. First of all those buy stop losses get triggered. All right, so whoever was buying off of this demand zone, their stop losses get triggered and the positions get liquidated. Secondly, a whole new wave of sellers jump in. What I mean by that is when they see that this zone here, which was being respected, has been broken through, has been induced. Now they're thinking, you know, that the price is about to reverse, right? A bullish trend that was happening is about to reverse and turn bearish, and sellers are in control. So you got buyers getting liquidated and sellers piling in simultaneously. Now there's a massive concentration of liquidity in this area. And then what happens? Price reverses and flies the other way. Right, it took out the buyers with their stop losses resting there, right? It took out the sellers that got trapped in the wrong direction with this breakout, and it created a completely clean environment with no resistance because everyone else could oppose the move has already been, you know, taken out. So all those weak hands, right, all those uninformed participants, their liquidity became the fuel for this explosive move. Because during that choppy consolidation, right, there just isn't enough liquidity. That tug of war between buyers and sellers were basically neutral, right? Nobody was winning there, all right? But after this sort of inducement, after the price induced this and then went higher to induce the sellers that thought the price was reversing, the real move is happening. And notice this thing, right? That the buyers are in control at the end, and you will be able to identify it, right? You don't need a special indicator for that. Your price will just literally show you that it's about to do something like that. Why? Is because if you look at the price action before, it was weak, right? It was directionless, it was choppy a bit, you know, it was moving sideways, right? The second the inducement happened, right, price exploded and it actually went towards the upside, you know, showing the real intent. So the liquidity hunt was the catalyst, right? And the inducement was basically the fuel that powered the move. Like I said in the beginning as well, that liquidity is fuel for the market, right? That is what is responsible for moving the market towards the upside or the downside. Now flip it to the bearish scenario, same concept, opposite direction, right? Price keeps tapping through the same high in this tight range. So you have this range here. Look how many times the price tapped into it. 1 time, 2 time, 3 time, right? Still respecting this high here, still respecting this zone here, right? That's your resistance level. You can also call it your supply zone as well, right? And for most traders, that's going to look like, you know, some sort of a reversal point, some sort of a ceiling where price can actually tap into it and then go towards the opposite direction. So what do people do? They put in the sell positions, right? And they're putting the sell position thinking price is about to reverse, and putting their stop losses right above the zone or stacking at random price points, right? Wherever they think that their stop losses is going to be respected. Now, if we can understand where that level of resistance is, we also know exactly where the stop losses are sitting, right? Which is basically right above here. Like we discussed in a bullish scenario, what happens is when price spikes through it, when price takes all the seller stop losses and it induces all of the position, what happens after that? Two things. First thing, obviously the sellers get taken out. Secondly, it invites, a wave of new buyers who see this like as a breakout, right? A bullish breakout structure. And then they think that, the buyers are in control. And then what does the price do? Price actually aggressively dumps. So the sellers got stopped out, whoever got into sales thinking that this zone will hold, and the buyers who thought that this was a breakout for a continuation bullish move got stopped out as well. They got trapped in it as well. And now both sides got completely cleaned out, right? The early sellers and the wrong direction buyers, and then the actual sellers end up in control. But again, not with the majority, right? In spite of them, because using everyone else's liquidity, creating an environment where buyers felt confident enough to enter for a long position, only to use them as a fuel by reversing the price by taking them out. Now that is what a real inducement looks like. Okay, so in both examples, bullish and bearish, liquidity was engineered around an inducement swept through it and a violent direction move forward immediately after. And like I've said it before, none of this is random, right? This is how price actually works. This is the real language of the market. And once you read these inducements, once you learn to confirm them, you start to trade, in a much cleaner environment, okay? Where the moves are more, intentional, directional, and are clean. But now this was one type of trap, okay, in a bullish and a bearish scenario. Let's look at another type, which is basically a trendline liquidity. Okay, this is another type of trap. Now this one basically, right, this one targets trendline traders. So we'll start with the bearish scenario. So a trend line is when we connect, the highs together. So you had some sort of a resistance level here, right, and you had these highs basically connecting at some point. There's always some sort of subjectivity in how you draw it, but the key point is to create another obvious predictable zone where the retail traders, they concentrate their activity, right? These traders basically believe that it's a protected level. They think that, the price shouldn't break through it, right? So once price taps into it, test it, they should be looking into some sort of a sell position. They take sell positions, right? Along the trend line with stop losses sitting where? Right above it, right? So they'll have their stop losses piled up right above this resistance level. So what comes next? Price pushes up, and breaks through it, right? It sweeps all the liquidity sitting along the trend line. Every seller, every stop loss placed above it gets taken out. But simultaneously, like we discussed in the previous type of liquidity as well, the market here is also attracting buyers, right? They see a bullish breaker structure here, right? They see the price is, pushing higher. And what they do is they think that the downward trend is done, it's over, so they enter for some sort of long positions with predictable stop loss placement. Okay, they'll be placing at this level here, this level, wherever they think that their stop loss should be respected, that's where they're going to be placing it. Now again, two sort of things are happening. So you've also got breakout traders jumping in, they're looking for a trend line break and retest. So just like the support and resistance, we have now concentrated on predictable stop losses getting taken out, followed by an invitation for more participants in towards the wrong direction. Okay, so once price breaks past this line, they take out the trendline liquidity traders. The price they're thinking is starting to move towards the upside. Then what happens right after that is that those buyers that got in because of the breakout also get stopped out by the institutions. So the institution removed the sellers and the buyers as well, right? And the actual move forward regardless of market structure and regardless of the resistance or the breakout signal or the trend line, okay? Inducement is the reality, right? Price literally travels from one pool of liquidity to the next. It moves from trendline traders pool to the demand zone pool, not because of structure, right? Not because of the trend line, purely because it was moving between concentrations of liquidity. Right, that is why liquidity is the oxygen of the market. It will travel from zone to zone seeking it out. Now, like we did it for support and resistance, we'll do a bullish version for trendline traders as well. Okay, now think of it this way. Basically has the same concept, right, just in opposite direction. So we have multiple touches forming again, right? So you have first touch, two touch, three touch. okay, in an ascending order, where these higher lows are basically connecting. Okay, we get an upward trend line, right? That is present as well. Now, retail traders believe more touches means stronger and more reliable, right? And what institutions see is more predictable, more obvious, more readable, and therefore more liquidity accumulating with each touch. Because when price makes a retracement into this level again, they're thinking, what are the buyers thinking? They're thinking that this level should hold. So traders, they keep the traders, they keep buying on it with stop losses right below this line here. And quite opposite to what the trend line traders think. They think the more the touches that level, that resistance point, that support point has, the stronger it is. It's actually quite the opposite, right? More touches doesn't mean stronger. It can actually mean weaker, because increased visibility means increased liquidity, right? And that makes it a target rather than, a safe zone. So what does the price do? Right? Very obvious. It drops through it. It manipulates it. It induces it. Not because of a bearish breakout structure or because sellers took control, simply because the market went to collect the most obvious form of liquidity present here. All right. Now, once those stop losses are swept, the next phase begins, right? The sellers get attracted. You'll always notice that in these sort of scenarios, you will either have the early sellers or early buyers getting taken out. And then, the people who are thinking that it's a breakout and prices, reversing, they'll get taken out as well. They'll get induced as well. So there's always two types of traders getting taken out. Now, once the stop losses are swept because of this push down, because of this inducement, the next phase begins, which is the sellers get attracted in. The narrative shifts to broken structure, find supply zone, sell the retest, more liquidity basically getting drawn in. What happens after that? Price gets pushed higher. Right? Price launches the real move, right? So they collected basically the buyer's stop losses by this push down, and then break retest traders who broke past this resistance level. We wait for a bit of a retracement to look for some sort of further sales. And what does the price do? Takes their stop losses as well, liquidates their positions as well. Liquidity will always dictate the truth, okay? You've seen the full picture of how liquidity structures itself, how it draws in participants, how price gets engineered to create traps, how the inducement, sweeps existing liquidity and then attracts fresh liquidity to actually power the real move. Now you understand, the types of liquidity inducements that are happening within the market. But sometimes, when you have, let's say, for example, that price is actually creating relatively equal lows, right? So you have equal lows present within the market. And even after an inducement of it, right, even after price manipulates, takes this liquidity, takes these equal lows, it doesn't actually reverse to actually go towards the bullish side. Instead, what it does is it actually keeps on printing lower highs and lower lows. We don't actually get the move that we were anticipating. Now, this is sort of a fake move, and that happens within the market as well. Now, the thing is, how do we differentiate between a real liquidity inducement versus a fake out, versus a trap, right? And this is what we're going to talk about now, so that you actually trade the actual move instead of actually getting trapped into the wrong direction. And now, to understand it, to not be trading the wrong direction, it comes down to two things, right? First is intent, and the second is control. And there are obviously filters. There's ways to avoid falling into that trap. The first thing that you gotta do, you gotta look out for, is basically time. The market doesn't make its important moves at random hours, right? Think about it. The biggest institutions in the world, right? The major banks, the hedge funds with the real capital, they operate during specific sessions. London session, New York session, or Asia session, right? That's where the real volume is. That's where the decisions are made. So if you're seeing what looks like an inducement, let's say during Asia range on a Euro USD pair, right? Which is basically, you have Euro, which is controlled by the European banks, USD, which is controlled by the US bank, right? Giving you some sort of inducements, during Asia range. Now, the probability of that inducement during Asia range of being, the real move is significantly lower, because the players who actually drive the market aren't even at the desk. And when you see an inducement form during the hours, those institutions are most active. Now, let's say London session or New York session, right? Now you're looking at something with real weight behind it, right? Now you can expect the real move to happen. And this is something, I've seen that a lot of people overlook, right? Time isn't just a filter, it's a weapon, okay? As a scalper, as a scalper myself, we're not here to stare at the charts for 24 hours straight. That just defeats the whole point of actually learning this craft and getting into this industry. It defeats the entire purpose. So you get into trading for freedom, right? And if you're actually glued to screen all day, you're already basically lost what you came for. When you narrow down your focus to specific time windows, right, you free up your time, you protect your mental energy. Importantly, you stop taking, you know, random trades that basically drain your account. You're only showing up when the probability is the highest. Now, the two windows that I basically focus on are just the first 2 hours of London session. Okay, so I've given you the time for it as well. And then the first 2 to 3 hours of New York, right? Frankfurt Open before London tends to be a trap, so I don't trade that, right? Mostly I do not take any trades during that hour. Very similarly, that New York Open often serves as a trap, or pre-New York, the hour before New York serves as a trap as well. And you know, then after that is where the actual direction, you know, takes place. Other 20 to 21 hours of the day is either low quality, or, you know, it's just dangerous for your account because it can bleed your account if you don't know how to stop. So you're either trading the noise or you are walking into traps. Now, the second filter is basically identifying the right zones with the right context. Okay, it's your point of interest basically, because not every level that looks like liquidity is worth trading, right? We need to understand what makes liquidity meaningful, and this is where most traders fall short, right? Because if you can't identify your point of interest correctly, then every zone, every, you know, level looks like some sort of an important one, and then you can actually trade off that thinking that it will hold, but it gets induced, right? So the point of interest are really, really important. Now, if you want to learn how to apply this live with me, my mentorship actually dives deep into liquidity, inducement models, session timings, and execution step by step. That is why inside Elite Traders Hub, we trade together live every single day. You have one-on-one guidance every single week, have daily analysis shared, you have question answer sessions, psychology talks, and community calls. And when you combine all of this together, if you want to really change your trading, come join us and you'll see the difference. That is why we've had members that have had thousands and thousands of dollars of payouts and more than $500,000 funding. And if you're ready to master this for yourself, the link to book your one-on-one call with me is in the description below. Now, let's put this all together, okay, with a real execution framework and build everything that we have covered so far. The way we're going to do it is we're going to do it through my checklist, my playbook, okay, and I will be talking more about my playbook. I have already done a video in the past as well. If you want to go check it out, I will leave, you know, maybe you'll see it on the screen, or maybe I'll leave a link in the description, okay? But go check it out because I do talk about my playbook right in there. And we will go really in depth, you know, on it in the future videos as well within this series. But right now, just to, you know, bring everything together that we've covered so far in the series in terms of technicals. Yeah, so we've discussed market structure, right? We've discussed supply and demand, how to properly use it as a point of interest, and today we've discussed liquidity. Okay, so we're going to combine these three things and try to understand what the market could potentially do. First thing first, you're going to identify the trend, right? The trend, it still matters. Yes, it can be used as liquidity, okay? But a trend represents control, you know, intent. It tells us the direction, okay? And they don't happen by accident. They often develop alongside liquidity. Finding the trend helps a lot, right? So here we can tell that the market is printing higher highs and higher lows. Yes, it was bearish for a minute, then it gave us a bullish breakout structure and is now forming higher highs and higher lows, okay? Secondly, we had you know, trendline liquidity or relatively equal lows here, which the price induced by this move, and then it pushed higher. Okay, so it's giving us the bit of reaction where, you know, price is making higher highs and higher lows. And now the next thing is basically to map out your liquidity pools, right? Where are the obvious levels, the support, resistance, supply or demand? In this case here, right, we have a demand zone, right? Where a very obvious zone here where the price can potentially, you know, retrace back into, pull back into. So far what we've done, the trend, we've had some sort of liquidity inducements. We have had breakout structures to confirm that liquidity inducement. We also have some sort of point of interest in a form of a demand zone where the price can, you know, potentially retrace into to maybe push higher. Now, from this point here, all of this could be on a higher time frame, right? Without going too much in depth on how to exactly use this playbook, all of this can be on a higher time frame, and then you can go down to the middle time frame, M15 time frame, M5 time frame. Then you actually wait for the time window, okay, and the lower time frame confirmation, right? This is where, you know, you have to be really patient, okay? You have to wait for the price to tap into your point of interest for your window to kick in. This is the start of London zone, so you had Asia range here, right? And then this grey box is your London session. You have to wait for London to open to manipulate into your point of interest, and then wait for a lower time frame confirmation. Just because price is in your point of interest doesn't mean that, you know, you can buy or sell from there. You always have to wait for an entry model, and once price has given you that, that is your cue to get into a trade. Okay, now that is basically your cue once price has given you a lower time frame confirmation. For example, in this case here, we had, you know, on M1 time frame, which is the entry time frame for me, I saw some sort of liquidity resting here in the form of a trend line. Price induced that liquidity, gave me a break of structure, made a pullback into some sort of an imbalance. Once it did that, I entered for a long position, putting my stop loss at this low here, at the protected low, and I think I was targeting 1, 2, 3 in this case. Now here's a bonus framework, right, that I'm going to give you, and this is sort of related to how to find, you know, A+ setups as well, which we'll cover in depth in one of the videos coming out within the series. Now let's say on M1 time frame, on entry time frame, right, price is giving us a bearish trend line, right? It's forming a bearish trend line. What does the price do? Goes higher, right, induces this entire trend line, the entire liquidity that was present, okay, and then gives us a bearish break of structure. Boss happens here. Now once this break of structure is given, right, this inducement of this trend line is confirmed, okay. That is a sign that, you know, the liquidity inducement has finished. Okay, now what you got to do is you gotta wait for, you know, a mitigation of an imbalance, you know, or some sort of point of interest, a pullback into that. Once it's done that, that is the point that you enter for some sort of shorts, putting your stop loss at this protected high, and, you know, targeting whatever objective is at the low. Now when you connect momentum with volatility, inducement with timing, you know, structure with liquidity, everything just flows. Okay, so the rest of the session just carries price in your direction basically. And here is what I want to leave you with. At this point, you're seeing the market completely differently. Okay, you understand how liquidity operates, how inducement forms, right? How price behaves before and after the traps. You've seen, you know, the mechanics of how the real players move the market, and how you can, you know, use precision and timing to position yourself. And once it clicks, okay, once you understand liquidity, once you understand inducement, right, there's no turning back. Okay, you will be able to spot it right away. You will understand it completely, and you'll read the story price is telling you, instead of just understanding it on the surface level. And that shift in perspective, that's the difference between, you know, a struggling trader and someone who actually understands the price. And as always, I hope you have enjoyed this video, learned quite a bit. Hit the like and subscribe button if you haven't, and I will catch you in the next one.